Hey everyone, Budget 2024 has been declared and this time it has a big impact on your personal finance as well as investment planning. In this latest budget, Finance Minister has made changes across the income tax slab, taxation on capital gain from stocks and mutual fund investment, taxation on capital gain on real estate, along with reducing the custom duty on gold. So in this video, I would discuss the latest changes in taxation and how it impact your personal finance and your investment goal. Alright, let's get started. So this is a comparison of your old income tax slab and new income tax slab. In your old tax slab, your income to 2.5 lakh is completely tax free. From 2.5 to 5 lakh, there is 5% tax. From 5 lakh to 10 lakh income, there is 20% tax. And beyond 10 lakh, there is 30% tax. In the new tax slab, income up to 3 lakh is tax free. From 3 to 7, there is 5% tax. 7 to 10 lakh, there is 10% tax. Then 10 to 12 lakh, there is 15% tax. 12 to 15 lakh income falls under 20% tax, and income above 15 lakh is considered under 30% income tax. Please note that in old tax slab, there's a rebate up to 12,500 rupee. So if your income is up to 5 lakh, then you don't have to pay any tax. However, in case of new income tax slab, if your income is up to 7 lakh, then there's no tax on that. Obviously, on the face of it, this new income tax slab look quite attractive because the slabs also suggest that taxations are low and then there's no income tax up to 7 lakh. However, there's a catch, and the catch is the deductions. So in case of old tax slab, there are multiple deductions that are allowed. For example, there's a deduction in ATC where you can reduce your income up to 1.5 lakh by showing investment in tax-saving mutual funds, insurance, tax-saving FDs, NPS, home loan principal amount, and so on. Second, there is ATCCD where there's additional 50,000 deduction allowed under NPS. Then you have got medical claim for 25,000 and 50,000 in case of senior citizen. Then next, there's a deduction of up to 2 lakh rupee on interest on home loan. So if you have got a home loan, then you can show that. And if let's say you don't have a home and let's say you are living on a rented apartment, you can show HRA. Apart from this, you have got LTA and you have got NPS contribution as well. So all these deductions are applicable for old income tax slab. Now, if you are someone who is a salaried employee and recently started and income is up to 7 lakh, obviously this new tax slab is better. But anything beyond that, you need to calculate by comparing the deduction and see which income tax slab is better. Let's take a simple example and try to calculate the income tax. So there's an income tax Excel calculator that is there where you just need to put your gross income, and if you opt for old tax regime, you need to put the deductions, and then this table will calculate the income tax and recommend which is better for you. So let's take an example where you've got 9 lakh of gross income, and let's say if you opt for old tax regime and show investment up to 1.5 lakh in ADC, let's say you have got a medical of 15,000, then there's a standard deduction of 50,000 in old tax regime, and please note that in new tax regime there's a standard deduction of 75,000 rupee. Okay, so that we have considered in old tax. Then we have not considered the home loan, NPS, and we have considered an HRA. Let's say you consider it at 75,000 rupee, or let's say 1,20,000 is HRA. So your total deduction is 3,35,000 in old tax regime, 75,000 in new, and your taxable income is 5,65,000 in old tax regime and 8,25,000 in new tax regime. Now, if you calculate the tax on new versus old, so your 5,65,000 is your old tax slab income. So again, 0 to 2.5 there's no tax. 2.5 to 5 lakh there's 5% tax, so that's 12,500. Now since your income is 65,000 more than 5 lakh, so here you have to pay 20% tax on that 65,000 rupee, which is 13,000, and total tax is 25,500. You have a cess of 1,000, which is 4%. So total tax is 26,520. Next, you have got new tax regime where your taxable income is 8,25,000. Now up to 3 lakh there is no tax. From 3 to 7 lakh there is 5% tax. So 5% of 3 lakh is 20,000. Then from 7 to 10 lakh there is 10% tax. So your income is 1,25,000 more than 7 lakh. So 10% of 1,25,000 is 12,500. And here your tax is 32,500, and overall your tax with new income tax slab is 33,800. Obviously your old tax regime is better here, right? So you can do the calculation and figure out which is a better income tax slab for you. So just to let you know, if your income is up to 7,75,000, then you can show deduction of 75,000 as a standard deduction under new tax regime, and your taxable income would become 7 lakh, and there's no tax up to 7 lakh on your new tax regime. So here you don't have to show all these deductions, and you can opt for new tax regime. But anything more than that, so let's say if your income is 8 lakh, and let's say again there can be a case where new tax regime is better, where let's say you just invest 1 lakh in ADC, medical is 15,000, standard deduction 50,000, HRA, let's say you are single and your rent is 75,000. In that case, the calculation suggests that your new tax regime is better. So you have to do all these calculations to figure out between old versus new, which is a better tax regime for you. So the analysis suggests that for a person with a salary up to 7.75 lakh rupee, your new income tax regime is better, because after 75,000 standard deduction, your salary would become 7 lakh and there's no tax on that in the new income tax regime. However, once your salary increases above 7.75 lakh, you need to check the deduction under the old slab and then compare which is a better slab for you. Next important change in budget 2024 is taxation on investment. However, before you even start your investment journey, let's get the basics clear for financial planning. The moment you start earning, you must do 3 things. First, build an emergency fund. This will help you during your rainy days. An emergency fund of 6 to 9 months is good enough. Make sure that you keep this money in relatively safer investment options like FD, liquid fund and so on. Second is take health insurance. With the rising healthcare cost, a few days of hospitalization can wipe out all your savings and you might end up even borrowing money. Especially with the growing lifestyle diseases, health insurance is a must from day one, so that you can get the best health treatment without worrying about the medical expenses. Moreover, when you take a health plan at an early age, your annual premium is low, and this premium increases with age. Hence, it's better to take it as early as possible. Now, it's not easy to choose the right health plan because every person has a different health condition and hence different requirement. Plus, health insurance documents are very lengthy with many terms and conditions that are difficult for a layman to understand. That's where my honest advice is to explore the Ditto Insurance platform. One of the biggest validation of their work is they have 4.9 star rating on Google with more than 8,000 reviews. The best part is you can learn every aspect of health insurance on their website before opting for the right plan. They have also simplified the health insurance plan in simple layman language so that you can get a clear idea about the health plan. In fact, you can also compare the health policy on their platform. And if you are still confused, you can book a free one-on-one call with their advisor. Friends, the best part of Ditto Insurance is they don't spam you with multiple calls or messages, and they provide genuine advice. By the way, if you opt for old tax regime, you can claim this health insurance premium for deduction up to 25,000 per year and 50,000 per year in case of senior citizen. Then third, you should take a term plan. A term plan is the simplest form of life insurance, which is again a very important part of financial planning. It is especially important when you have dependents in your family like your wife, kids or parents, so that in case of an unfortunate event, your dependents can live a dignified life. Once you plan for emergency fund, health insurance and term plan, you need to invest your money for your financial goals. And one of the most popular assets for investment is the equity market. So let's look at the latest changes in taxation for equity investment in budget 2024. So in the latest budget, government has increased taxation on capital gain on stocks and equity mutual fund. This was the most unfortunate part of the budget. So there are 2 tax slabs on capital gains from stocks and equity mutual fund. If you sell your stocks or equity mutual fund before 1 year, it attracts STCG, that is short-term capital gain. Earlier this tax was 15%, but now government has increased it to 20%. And if you sell your stocks or equity mutual fund after 1 year, it attracts LTCG, that is long-term capital gain. Earlier this tax was 10%, now it has increased to 12.5%. Although there is one positive change, earlier the long-term capital gain up to 1 lakh was exempted from tax, and now this limit has increased to 1.25 lakh rupee. So let's say you invested 2 lakh rupee and your total value of investment is now 3 lakh after 1 year. You made a profit of 1 lakh. So there was no tax on this profit in the old tax regime. Now this limit is increased to another 25,000. So if your total investment value is 3.25 lakh, you don't have to pay any tax on this 1.25 lakh profit. For example, if your investment amount is 2 lakh, duration is more than 1 year and total investment value is 3.5 lakh, your profit is 1.5 lakh. Since capital gain up to 1.25 lakh is now exempted, you have to pay 12.5% tax on the remaining 25,000 of profit, and that would be 3,125 rupee. So for those who have a small investment, this is a good news. But for those who are investing a bigger amount and the financial goals are of longer duration like retirement planning, buying a home and so on, in that case, the old regime was better and this new regime has higher taxation. Now let me share a quick Excel calculation to help you understand this new tax rule is better till what profit. Now let's take an example to calculate your income tax on stocks and equity mutual fund from old taxation perspective and new taxation perspective. Here I've considered an investment amount. Let's take any investment amount. Let's take a investment amount of 5 lakh rupee and let's take a duration of 2 years. Now since the duration is 2 years, you qualify as long-term capital gain, and let's say your 5 lakh has become 8 lakh. Okay, so your profit would become your 8 minus 5, which is 3 lakh, right? Now the catch is that in old taxation there was deduction allowed under 1 lakh. So profit up to 1 lakh is tax free, which means your taxable profit is 3 minus 1, which is 2 lakh, and tax was 10% earlier. So your long-term capital gain was 10% in old taxation. So 10% of 2 lakh is 20,000. In new taxation, there's a deduction allowed for profit up to 1.25 lakh, which means 3 minus 1.25 is 1.75 lakh. But the catch is you have to pay a tax of 12.5%. That comes out to be 21,875. Clearly your old taxation was better, and in new taxation you have to pay higher tax. Now the question is, until what profit your new taxation is better? So my calculation suggests that if your profit is up to 2.25 lakh, so let's assume your investment amount is 5 lakh, duration is 2 lakh, but value is 7 lakh 25,000. In that case, you will end up paying same tax. So the amount is 2.25 lakh. If your profit is less than 2.25 lakh, this new taxation is better. And if your profit is more than 2.25 lakh, then you'll end up paying higher tax in this new taxation slab for your stocks and equity mutual fund investment. In the latest budget, there's a major change on capital gains from the sale of real estate property. Earlier, the rule was that if you sell a real estate property after holding it for 2 years, it qualifies under long-term capital gain. And there was 20% tax on profit, but with indexation benefit. However, in the latest rule, government has reduced the long-term capital gain tax to 12.5%, but removed the indexation benefit. Now, this indexation benefit was very important. It basically adjusts the purchase price of an asset against inflation, so that the actual inflationary gain or loss can be accurately determined when the asset is sold. Let me share a simple example of taxation calculation on real estate. Now, this is the calculation on your gain on real estate. As discussed earlier, there was an indexation benefit. And what is that? Here there is a cost inflation index that is already provided, and here is the calculation. Let's assume that you purchased a property in 2001, okay, and under both old and new slab. And let's say your purchase price is 50 lakh, okay, and your sell period is your 2023-24. In that case, you have a inflation adjusted cost. This is very, very important. That's where taxation comes into picture. And how do you calculate this? It is calculated by simply multiplying your purchase price with your 2023 cost inflation index and dividing it with your purchase period of 2001-2002. So this is the base here, and if you just enter it, your inflation adjusted cost is now 1 crore 74 lakh, right? Because of inflation, the value of 50 lakh has actually become 1 crore 74 lakh. Now let's say you sell it for 2 crore. In that case, your profit would be 26 lakh, and there was a tax slab of 20% earlier that calculated a final tax of 5 lakh 20,000. Now the catch is that in new tax slab, there is no indexation benefit. So your sell price is 2 crore and your purchase price was 50 lakh. It means you ended up with a profit of 1 crore 50 lakh. Although your tax slab is now reduced to 12.5%, but this 12.5% on 1.5 crore of profit is 18 lakh 75,000 rupee. So In this case, clearly you will end up paying a much higher tax with your new taxation. Now let's take another example where your purchase period is, let's take it's 2015-16 and let's do the calculation. Let's keep the purchase price as 50 lakh. Sell period is 2023-24. Now let's calculate the inflation adjusted cost. So here your inflation adjusted cost would change completely and it would become, your division would be with your 2015-16 period. So your 50 lakh of purchase price is now inflation adjusted value is 68 lakh 50,000. Let's assume you ended up with a sell price of 1 crore 20 lakh. In that case, your profit is 51 lakh 49,000, right? And 20% tax would be 10 lakh 29,000. In the case of new tax slab, you will end up with a profit of 70 lakh because purchase price is 50 lakh, you are selling it for 1 crore 20 lakh, and 12.5% tax on 70 lakh is 8 lakh 75,000. So this new tax slab is better when the investment horizon is shorter. However, if you have a very much higher, longer duration of investment, then there is a case where your old is better. So again, you need to do the calculation to figure out which is better for you. But here the change is that the new tax do not consider the inflation adjusted cost and they've reduced the tax slab by from 20% to 12.5%. In the latest budget, government has reduced the custom duty on gold from 15% to 6%. Because of this move, gold price fell down by 7-8%. Now this correction is good for those who want to buy gold now, but it is not great news for those who invested in sovereign gold bond 8 years ago. Actually, sovereign gold bond are one of the most popular investment medium for gold investment, where government gives an additional 2.5% interest every year. However, there is a lock-in period of 8 years on sovereign gold bond, although you can choose to exit after 5 years. Now with this latest change in custom duty, those who participated in the sovereign gold bond scheme 2016-17 series are nearing their final redemption, and this fall in gold price would impact their returns. In fact, there are also discussion about the government discontinuing sovereign gold bond in the future, although nothing is confirmed yet. So in this video, we discussed the key update in latest 2024 budget and its impact on your income tax as well as investment across your stocks, equity mutual fund, real estate and gold. Now these taxation are not in our control, but from our side what we can ensure is that our financial planning is on track. And for that you need to build an emergency fund, buy a health plan and a term plan. And for that you can explore the Ditto platform and book a free one-on-one call with their advisor. And then invest your money across asset classes as per your financial goals. So this is it for this video. If you find it useful, do share it within your circle. I'll see you next video. Till then, take care.